Hey guys, it's Chris. Hope everyone is having a great Thanksgiving. Wanted to resurface this awesome interview I did with Keith Wasserman, founder of Gelt. Keith's an awesome friend of mine, building a multi-billion-dollar company. He's a beast, and we have a great conversation, kind of how it all started. So thanks so much for continuing to join me. And again, have a great Thanksgiving. Today's episode of The Fort is brought to you by none other than Fort Capital. Fort Capital is a real estate investment firm based in Fort Worth, Texas, with a track record of acquiring more than $587 million in assets throughout the great state of Texas. The team over at Fort is currently looking to acquire Class B industrial properties between $10 and $75 million throughout the major metro cities in Texas. In fact, Fort Capital was named the fastest growing real estate company in Texas by Inc. magazine last year. To learn more about Fort Capital, visit fortcapitallp.com. So Keith, tell me about how Gelt got started and kind of the quick, or not even quick, but the story of how Gelt started and where you are today.
Yeah, definitely. So first of all, thanks for having me on the show here, Chris. And, I've always been very entrepreneurial. I'll take you back to when I was 10 years old. In the household, we weren't really talking about, movies and sports. And, I would attend an occasional sporting event with my dad and stuff. But we talked about business and entrepreneurial kind of activities. And my parents, they brought me to Costco, and we went to Costco and bought boxes of candy bars and then sold them one by one at the park, so buying at retail and wholesale and selling at retail. And then in high school, one of my dad's friends taught me how to negotiate, and it really stuck with me that you really make money on the buy. And we bought 1,000 leather jackets, and I started selling them to all the students and the parents and the teachers. They were IRs, they regulars, they had little blemishes on them. And I made a ton of money in high school doing that. And that led to my next business, which was an eBay operation. We bought and sold around 200,000 items on eBay from 2003 to 2007 while I was in college at USC, University of Southern California, here in LA. And I've never worked for anyone in my life. I'm sort of like a serial entrepreneur, and I just wouldn't make a good employee. I literally, my dad's like, you should learn real estate, come work for a friend of mine. So I was there 9 o'clock. I left at noon at lunchtime. I just couldn't find myself working for anyone. And I have no problem, filing paperwork for myself, but I didn't really feel like that was the best use of my time doing it for others. So I wanted to really learn by doing, and I was always intrigued by real estate. My dad's a pretty successful attorney here in LA, but I really believe he's made most of his money in real estate investment and development. So it's just really an amazing business that you could do at any time in your life for your whole career. And we started very small. My cousin, Damian Langeri, came to me with the opportunity to buy a 4-unit building in the Central Valley of California in a city called Bakersfield, which most people in LA don't even know exists, actually, even though it's the 9th largest city in California and like the 39th in the United States. It's around 2 hours north of LA, and it's based on oil and agriculture, a very industrious town, but it got hit really hard during the recession, housing prices, and it was a boom and bust kind of situation that was overbuilt and then busted even before LA and other areas. So we got there really at the bottom of the bottom when there was REOs galore. Previously on the line, we were talking about, how anyone could get a residential mortgage. And we bought 15 little fourplexes. They were selling for anywhere between $100,000 to $150,000 for the whole building. And they previously sold at the height of the market, maybe 04, 5, 6 for around $400,000 to $500,000. So really no brainer, making money on the buy, which is a recurring theme. And we got some residential financing. Our mortgage payment was around $600-$700, and each unit rented for around that price. So if you had 2 units, you were making money. 3 or 4, you were cash flowing like a pig. And I cut my teeth driving up to Bakersfield every week with Damien. It was some of the happiest times of my career, learning the business. We didn't have anything. We were both living in my parents' house. I was 25 and he was 29 when we started this business 10 years ago. So, it's been an exceptional ride, and we're very fortunate, but we got our start really just by doing and learning and, having good mentors around us and reading as much as we could, but literally just starting very small and doing, these activities.
That's fascinating. And to stay on that topic for a little bit. So you buy 15 duplexes in Bakersfield, which is a drive away. How did you get them? Did they require remodeling, or did they require, or did y'all do it yourself, or did you sub that out to people?
Yeah. So Damien was the one that really his father was in Bakersfield actually, and he pointed us to that town. He was investing in real estate and sort of got burned during the bubble because he bought at the height of the market. But he said this is a great market, and he was very hands on with the contractors, knew which contractors were reputable, who to work with. So, and he really taught us how to negotiate, how to bid out projects, what to look for when we were doing these remodels. All these buildings were pretty much boarded up, bank owned, left rotting, and we came in and spent a decent amount of money renovating. They were in the rougher parts of town. So another recurring theme I've had is don't over improve the buildings. We make them very nice and clean, because at some point there's diminishing returns. If you put extra dollars in, you're not going to get it out. So we made these units livable, clean, nice, didn't over improve, and we were able to rent them out relatively quickly because they were nicer than the older building stock in those areas. Another important lesson I learned through this process is just because something's cheap doesn't mean it's a good deal. All these initial fourplexes were in rougher parts of town, and we didn't make as much money as we liked, but it set the building blocks for learning about where to buy, and we started buying in better locations in Bakersfield, for example, but better areas, and we did much better on those assets, and that led us to new markets. We moved into Phoenix, Arizona right afterwards. This was 2010-11, and Phoenix was reeling through after the bust. We bought 2,000 units there from 2010 to 2013 or 14. That was our biggest market, and we just kept moving into new markets, year after year, and buying one property at a time, essentially. So,
Yeah.
It was a big adjustment though, moving from a fourplex to a larger apartment community. I couldn't have done it with a lot of people ask how in the hell we did this. We built a track record. We had 15 of these little fourplexes with a few family friend investors that put up some money for us. And we showed them that we could, renovate and rent out and cash flow these assets. So I brought on 2 senior partners. We call them the gray hairs that could qualify for a larger loan and help bring in some new investors. So one of the gray hairs was my father that I actually brought in as a partner. And then another gray hair gentleman, Adrian, who's no longer with us now, but was an instrumental partner in our beginnings, helped us. And so we bought a 78 unit building in December of 2009, a full year later. And that was our first foray into larger multifamily assets.
Wow. Is Gelt vertically integrated? Do y'all do management, construction, and everything, or do you third party out some of the services?
So that's a great question. Initially, we didn't have any great luck with the property management companies in Bakersfield that were managing our fourplexes. So we actually created our own management company to service that, and then we started taking on other clients. It was pretty much a disaster. We're not built to be in the property management business, especially remotely. Maybe I'd have a different opinion if all my assets were in LA, but even from the beginning days, we outsourced management on the larger assets, and we eventually got out of the property management business. Now all of our apartments are managed by large, reputable third-party management companies that are in the different regions. They're the best ones in regions that we're in. So we have 3 or 4 different management companies we work with, and we're very hands-on with those management companies, but it allows us to stay small and nimble. It sounds like we have about the same size organization. We have around 25 people in our company. If we had to do our own property management, we would have over 200 staff, because all these sites have between 5 to 15 staff members between the leasing office and in the field, all the maintenance techs and stuff. And then we would have to have regional managers and constantly training, hiring, firing. I didn't want to be in the people business. I wanted to be in the real estate investment business. So, that's our motto. People have been successful both ways. There's no right or wrong, but I think it's allowed us to scale quicker by not being bogged down in the day-to-day management.
We came to the same realization. We started out early on our end doing property management and quickly did a head count of what we would need to hire to get into full property management, and came to that same conclusion that we were better off being great asset managers than property managers. So You talked about friends and family money. Is it fair to say that when somebody's raising friends and family money, that first investment in somebody is mainly more based on, I'm going to invest in Keith and I know he's going to give it everything he has, than necessarily Keith knows everything about real estate and there's no doubt that he's going to hit a home run in real estate. Would you agree it's more of an investment in that person than the actual project itself
100%.
early on?
And even in this day, we've raised over $350 million. To this day, I always tell our investors and potential investors, you're investing in us. You're investing in the jockey. You're investing in us because during good times, during tough times, you could trust us. We're very open and transparent about how things are performing on the property. We have a great track record that's also a plus, but you really are investing in us. And even more so in the early days when you don't even have that track record yet. We've only once lost money on a little fourplex. It was like $30,000. We took that out of our own pocket to pay our investor back so we could have a track record that says we've never lost any investor any money. So it's a people business, definitely. And, we want to have a stellar reputation and keep that reputation for sure.
I love it. You are highly focused in multifamily. You also own mobile home parks. Why multifamily and why mobile home parks?
Yeah, that's an excellent question. So in the formation of Gelt 10 years ago when we started, we had to make a decision. Did we want to go in the single family residential or the multifamily? We were looking at tapes of these single family homes that were located all over the country pretty much. And just in our heart, we thought that was going to be a very difficult business model to aggregate and manage all these assets located all over the place. We like the model where you have max in one apartment community could have, some of our buildings are 400 or 500 units in one building instead of going to 500 homes that are scattered miles apart, for example. So
right.
we like the business model much better on multifamily. You could finance it much better. The aggregators have done okay. Some have gone public and raised a lot of money. I don't think they've made tons of money on like operations. It's more just price appreciation. It was a one-time, in our lifetime kind of thing to be able to buy all these REO homes. I'm in the business of long-term holding. I don't think these companies are going to be around long-time holding these single-family homes. I think eventually they're going to dispose of them. I'm all about preserving capital, growing it over time. And multifamily, we thought is the best way to do it. We looked at office buildings, shopping centers, never loved the business model. We saw the way people were shopping was changing with the internet. We saw the way people were working was changing with collaborative workspace. And just, we made the right decision back then to start in multifamily. We've had, strong tailwinds, but I'm still very bullish on it for the long term. We see different kind of concepts that are popping up that we're going to start experimenting with on the development side, such as co-living, micro units, et cetera. But it's still, where people need to live a place with a roof over their head. Since the recession hit, you have 9 million new renter households that are formed, and there just hasn't been enough housing, multifamily housing built. So you still have a supply-demand imbalance. That's why you're seeing rents continue to grow. Also, we're big on workforce housing, buildings built 70s, 80s, 90s that have lower rents than like newer buildings, dramatically lower rents. So we'll come in, we'll do interior renovations, exterior renovations, manage it better, lift the rents in the process, and provide a better, home for people to live. And, it's a win-win scenario, whereas some of our peers are buying brand new buildings and we just can't get the same kind of yield. So we like workforce housing. Commercial, you have issues with, if you have a big tenant that leaves, you have vacancy for a long time. It could whack your cash flows. You could have no cash flow or have to feed the property for a long time until that leases up. You have broker commissions that eat into the cash flow. You have tenant improvement dollars. So the cash flow is a lot lumpier, and we're dealing with individual investors, and I want to be able to just have, consistent income stream coming to them through, always being around 95, 96% occupied on these buildings. Maybe at the lowest 92, 93% at certain times, but it's always going to have pretty consistent cash flow. As long as you don't over leverage, you're going to be fine for the long run. Some of our peers got hurt, over leveraging in markets like Phoenix that rents dropped 20% from peak to trough. But if you didn't over leverage and you were able to hold the buildings through the recession, those values are up dramatically more than they were, right. And the rents are dramatically higher. And that's it. You just got to mitigate your risks and lower leverage. And we do long-term fixed rate debt. We raise a lot of money up front, extra for cushion for rainy day, and real estate's not a get rich quick thing. It's just a way to build wealth over time, pay down that mortgage and have rents increase over time. And, the replacement cost of things increase. And it's just a great way to park money and have great, and there's all these tax benefits also. So it's just a great way to preserve and build wealth over time, I'd say.
How do you think about the future? Do you think renting is the future or ownership is the future, especially as, millennials and the younger generation require more flexibility? They're not getting married as quickly. They're not starting families as quickly. They're not having as many kids. They're having more pets. There's a debate out there that the future of the world is renting, not owning. I fall in the future of being closer to renting. Where do you stand on that? And I'd imagine if it is renting, that bodes very well in the multifamily world.
Yeah, I think there's always going to be a subset of people that want to own, but the renter generation population is going to continue to boom with the millennials, like you said, and then the other end of the barbell, I think the boomers are also becoming more of a renter because, they downsize from their home and there's a lot of renters by choice, not just by necessity. I believe, I think home ownership went from around 69% to like 62%. It finally started stabilizing. It hasn't dropped anymore. Some countries like Germany or like cities like Berlin have a lot higher renters than home ownership. And then some areas like that we've been in, like China and Israel, it's all 100% pretty much home ownership. But they're starting to see a lot more rentership, and it's becoming more and more okay to rent rather than having to own. And I think we're going to continue to see that for sure in the U.S. Is it going to drop to a 50% level, of homeowners versus renters for the whole country? Maybe not, but in certain markets it already is. I mean, where it's just extremely, extremely expensive to buy homes. So I'd say, I think that the tailwinds are still at our back for renters and being able to be more mobile, especially with work, new age of work. Yeah.
You mentioned co-living, you mentioned micro units. It seems like there's a new app every day that's an amenity for multifamily and the tenant experience. I've said a lot that it's almost like in some way there's a lot of experimenting going on with the way we think about living. What are some of the biggest kind of changes that you've seen since you started buying larger complexes in 2010 to where we are today?
Yeah, I agree with you there. Every week there's a new app that pops up, and it's a nice thing to have, but not a real. I don't think it's really solving a serious need, and a lot of them have come and gone. We've invested in a lot of early stage tech startups and a good amount in the real estate space. We started our own financial technology company called Demuso, which handles all the rent payments on these large multifamily properties, where we saw a real pain point for both the renter and the owner. What was the question again? I was got sidetracked with the.
Yeah. What are some of the biggest kind of changes that you've seen in the way that people think about living, and then what does the next kind of 5 years look like with all this? You mentioned co-living and micro units, and on top of that, all the apps. Like, it feels very experimental with how people think about living today, and where we're going to be a decade from now.
Yeah, definitely. So. I really think in certain markets, you're going to see more of that co-living expand, where people could pay a lower price, just to rent essentially the bedroom.
And what is co-living?
A lot of that co-living is essentially sort of like a dorm, essentially style living, where you rent the bedroom. It could be furnished or unfurnished. You have maybe 4 or 5, rooms around a communal kind of kitchen den area. It could have a shared bathroom, or I believe, better scenario. Obviously, everyone pretty much wants their own bathroom. And right now, lenders are sort of gun shy on lending on this kind of thing, and lending because you can generate a lot more cash flow from renting on a square foot basis on these units, renting by the bedroom instead of the whole unit. I think in certain markets, it's going to be really popular. We're looking at doing it, but with less frills. A lot of these co-living buildings are amenity jam-packed and, just very high rent still, even though you're getting a small space. My thought is just low amenity, but really high in design, and, just keep the cost affordable.
Right.
Micro units, the same thing. We have friends that have been developing micro units locally here in Santa Monica. They've done very, very well. So certain areas, I think bodes well for that. I didn't talk about it yet, but manufactured housing, I'm still extremely bullish on as an investment. It's a scenario where the resident actually owns their own home, and as the owner of the property, you just lease them the space, the lot. And we bought around 8 manufactured housing communities over the last 2 years. They're really not building many new communities in the U.S. Most cities don't want them. They don't create the same kind of tax revenue. A lot of the neighborhoods are against them. And it's just a great business that is really niche and there's literally around, I think, 20 million people that live in a manufactured house in the United States. And it's a great business. You can finance it with Fannie and Freddie debt, which we do on all our, apartment buildings for the most part, generate a tremendous amount of cash flow. And 2 years ago, it was a lot easier to buy and make a lot of money on these things. But now you have a lot of institutional capital pouring in from the likes of like Carlisle, Brookfield, Colony Capital, et cetera. So it's getting tougher as an apartment buying, finding good deals there. But still love the asset class because it is where people live. The residents stay on average 10 years. So you have long tenancy. It costs a lot of money to disassemble and transport a home. So those homes pretty much stay there. And yeah, we buy pretty much three-star communities, and it's workforce housing. It's affordable, $300 to $500 lot rent, and where the apartment rents in those markets are at least $1,000, $1,200 plus. So you're less than half the cost of apartment living, and you don't have to share a wall with someone. And we make these communities really nice, really attractive landscaping and adding amenities, and it's been a good business for us too.
So as the owner, you're responsible for the common areas, the amenities, and then I'm assuming providing electricity and water to each lease space?
Correct. Yeah. So it's we're long-term holders of real estate, and this asset class is like the least cost like for CapEx over time because you don't own the actual homes, whereas on our apartments over the years, we're going to have to replace roofs and asphalt and, electrical systems and boilers and chillers and all kinds of stuff, where it has much less CapEx requirements over time. So the negative is in a good market, you can't push rents as quickly as an apartment would. But right. The flip side, I think, is during a down market, I don't think you're going to see the same kind of, drop in rents. So
are people signing annual contracts or leases? Or are they signing, multi-year, 5-year, 10-year? Is it just year to year?
Yeah, it's pretty much year to year, just like multifamily. And we've seen rent growth, not as much as in multifamily, but my asset managers love dealing with it because it's very little things going on in the property. And we try to buy communities that have little park-owned home inventory. If we do inherit a community, if we buy a community that has some park-owned homes, we'll try to sell them off to start just getting that lot rent going. And it's been a great business.
That's great. Are there any other asset classes that y'all are focused on besides multifamily and mobile home communities?
Yeah, a third one that sort of fits our criteria is self-storage. Also, another one that's a very low CapEx required asset over time. We like buying those in high barrier to entry markets. So we bought our first one a few months ago, actually, in Southern California here in South Pasadena. It makes a great redevelopment site as well. This site was on the light rail on a street that has tons of retail, shopping, et cetera. And, it was built in the, early 90s, a long time ago, before the area has really changed a lot. And I think, the rents were extremely below market, and it's not going to require as much money to renovate as an apartment community to get the rents up. And literally all the other storage facilities in the area were all, 98, 99% occupied. And there was a moratorium actually in South Pasadena. So there's not going to be any new competition even built. So, that's another industry we really like. I'm cautious about technology impacting that one, though. You have a lot of tech startups in the space, but I think that's only going to serve niche customers. And I think self-storage long-term still going to be a good asset class. So we're doing that. And then we bought an RV park as a really interesting opportunity. It was a 66 site RV park in Monterey, California, right on the ocean. And it had extra land adjacent to it where we could build an extra 22 pads. So it had, I think they went through their entitlements and got their final permit, but they let it lapse because they did it right, I guess, right before the recession. So we're going through that process right now again. And it's going to be a huge value add once we get those sites going. And we've also added a lot of cool ways to make more money. Glamping tents for certain customers that don't want to just pull in with an RV. They want to fly up or drive up and stay in a tent or with a bed and a heater, etc. Or whereas before people were pitching their own tents and they were charging $20 a night. Now we charge around $200 a night for this glamping tent, which is a great boost to the NOI for us and our investors. And then we have some small tiny homes we rent out nightly there, and some Airstreams, and we've added a beer and wine license, and it's more like running a hotel. It's pretty involved, and it's sort of a passion project, but we saw a huge amount of upside, and it was an irreplaceable location. So I'd say we'll look at more of those. RVing as a whole, as an industry, is really picking up. I think last year or the year before has seen the most RV sales ever. They started really picking up. You have millennials now that are more, traveling the country and are more mobile, and you have the boomers that are a big, population that likes doing this. Being a city guy, I've only done it once, but I had a lot of fun being in an RV driving up the coast of California. So definitely, a good asset. RV storage is another one that we're looking at because people, in cities don't really have places to put these RVs, and they'll pay up for storage because these RVs could cost up to $500,000. I mean, it's pretty amazing. It's expensive as homes in some areas. So, it's a second home for people essentially. So yeah, I'm bullish on that too. And we're entrepreneurial and opportunistic, but the bread and butter of what we do is still, multifamily.
Yep.
Value add for the most part. We do some development, but only locally in LA where we know the areas, know all the local, rules and just it's in our backyard. It's easier to oversee.
Yeah. No, so the RV model is a lot more short-term rentals, people coming in and out, as opposed to mobile home parks, which is a long-term stay.
Correct. Yeah, the mobile home park, it's called mobile home, but it's really not mobile. It costs around, I've heard $7,000 to $10,000 or more to disassemble and transport, a manufactured home. And you sometimes see them going down the highway in sections. There you have like single wide, double wide, triple wide. So they do them in sections, and yeah, it's a costly thing to move. So they're very stationary, and if a resident wants to leave, essentially they own their home, they'll just sell it to another person that will buy it, and then continue paying that lot rent. So it's definitely not mobile. It's not a stationary.
Yeah. I love how you think about, although you are investing in real estate, what you're also, a pattern that I'm hearing is you're paying very close attention to human behavior and what people are up to, and helping that be your guiding light into what asset classes might be most profitable for you and, of course, your investors.
Absolutely. Yeah. We're constantly, seeing what the big trends are and, looking for opportunity. I think someone asked, what would I be doing now if I was just starting the business in this market? I'd say I would take a close look at, they call them cloud kitchens or ghost kitchens. You have Travis Kalanick of Uber he bought into this business and he's running it now, called Cloud Kitchen. And they are essentially, what they're doing is they're taking industrial buildings that are sort of infill, converting them into commercial kitchens, allowing restaurateurs to essentially open up an online-only restaurant without having a physical real estate footprint. And so it keeps the cost down. It's turnkey. A restaurateur could start with one concept, see how it does. If it doesn't do well, switch to another concept. So you have not just entrepreneurs and startups, but you also have established restaurants that take space in these cloud kitchens, and they literally, it doesn't bog down the back of the house because you have so much more delivery because of Postmates and DoorDash and Grubhub. And I think it's really, why need that real estate on the, very expensive real estate to rent out if you're doing a lot of takeout business. Maybe you could, have a smaller footprint and have different locations preparing the food offsite and partnering with these, or developing your own. I don't know exactly what they're doing, but essentially all these delivery services know where people are pinging from. So if they see a lot of people pinging from a certain part of LA, let's say, for their restaurant, they don't have to be located there. They could just have a kitchen there, cloud kitchen, and make all the food and deliver and build a big business. I think you're going to see some monster companies that are built on top of these platforms that don't have any physical footprint. Like the next McDonald's could be built, with this kind of platform in these commercial kitchens and be 100% delivery only, or start delivery and then start having physical footprint too. Just like retailers, you have ones that started online, and it's becoming more and more expensive to advertise online with Google and Facebook and Instagram, and now they're opening physical stores. They're e-commerce first, but they call it omnichannel now, where they actually then open a physical footprint. So you have like, I guess, Bonobos and Warby Parker started this way, and in Santa Monica, in Century City here, the mall, the Westfield Mall that was recently renovated, you have a ton of these brands that were native online, and then they opened up a physical location after. So I think you're going to see more of that in restaurants and that trend with these cloud or ghost kitchens. They're doing it. They started in other countries like in India years ago, and I think it just started catching on here. But it makes sense to reposition old, outdated space for this kind of need.
That's fascinating. Travis, if you're listening to this, we have a lot of industrial in DFW. We'd love to be chatting. How do you think about going into a new market? What drives you there? And then once you have decided on a market, how do you kind of set up? How do you find your property manager? Who's going to do all your construction and renovations? Do you have to achieve a certain economy of scale to be profitable in a new market? How do you think about all that?
We're sort of market driven first. So we'll study, months or years on a market, really understand the local market, and then dive in big in that market. Any market we go into, we try to get at least 1,000, units. So our first market was Bakersfield. We liked that one based on oil and agriculture, its proximity to LA, and prices were whacked really hard there. We got there first. It came out of the cycle really nicely. Oil was over $130 a barrel at the time, and it was doing really well. They added a ton of jobs, and then we moved into Phoenix because we studied that market and saw that it was I think 8th largest city in the United States. It's one of the top 10 largest cities, maybe 5th actually. It's a huge city, and I've been growing up going to Phoenix. My grandparents lived there. Saw the market just boom, and they had a huge bust. And I knew in my heart it wasn't going to be down forever. They had the immigration bill passed that 100,000 people, illegals, left, and a lot of these communities were reeling because of the loss of people and jobs. But literally, it rebounded very nicely, even quicker than we thought. We first do all our research remotely, then go on the ground and then understand the local market, study the local market, talk to all the local brokers, talk to local business owners, economic development corporations, wherever we could get a lot of data on it, and then introduce ourselves to all the brokers that focus on these multifamily properties, 200 units and up, which is the ones we're buying. And in small markets, you might have only 3 or 4 players that are selling these kind of assets. In larger markets, you could have 10, 20, 30, 40. I mean, it's still limited. And 99% of the sales of larger assets go through brokers. So we just literally build relationships with the brokers that we're trying to buy in those areas and get on their distribution lists. Most deals are widely marketed. Some are marketed only to select few groups, which we hope, and we are on most of these short lists from these brokers. And at the end of the day, what differentiates buyers, I believe, in my heart, is performance, being able to perform at the price you go into contract at without retrading, unless there's something really material that was not disclosed. The broker wants to make sure that commission's in the bag, and same as the seller. The seller wants to know that there's not going to be any retrade where they have to bring it to market. So literally having good relationships with the brokers and sellers is what allowed us to build this company.
That's awesome. When you get there, how do you trust who the contractor is going to be? That's one of the places where things can go really wrong and get out of budget. Subs are walking off the job. How do you get really comfortable with who's going to do that work for you?
We always lean on the management companies we work with because they have pricing power, and they know through experience, because they've been working with these GCs for a long time. They know which ones are reputable, which ones don't overcharge. So we always bid at least 3 times for large projects. We oversee all the major CapEx work, but we work hand in hand with GCs that have worked with the management companies. So you asked about management companies. So we have one that's sort of our go-to. It's called AMC, and they're based in Salt Lake, but they have a big presence in markets that we're in, like Denver. So they manage around probably 2/3 of our assets. If they're in a market that we're going to, we always make sure that if they have a good regional presence there, just because they're in a market, it all boils down to the people. So it's like we like their company and their culture and what they're all about. And they're very aggressive, for example, on other income, and they run a pretty lean ship. But as long as they have a good regional presence there in those markets, we'll go with them. If they're not located there or they don't have a strong regional presence, we'll go with the 2 or 3 other ones that we use. We always vet the management companies, talk to other clients of theirs, and it's a small industry. Like all the large multifamily owners know each other. For the most part, we all go to the same industry events, and that's another thing. I always try to be a friendly competitor with people because we're always buying and selling from each other. So, like for example, 8 of our last 9 deals we bought from one large fund that sells 40 plus deals a year and buys 40 plus deals a year. So I'd say just it's all relationship driven, and we lean on our relationships with our management companies just like we do with our brokers.
So have you found a lot of success in building relationships and finding opportunities going to some of these bigger multifamily conferences?
Yeah, I view it. I read a lot, so everything that they talk about, pretty much on the panels, I read and know the people and stuff. So I focus when I go to any industry event, just actually networking and talking to people that we have relationships with, or potentially new relationships. So getting in front of brokers and sellers, and industry events are good for that because they come from all around the country to those industry events. For apartment business, you have NMHC is the main one. I go to NAA and RealShare. So there's 3 or 4 that I go to every year for the apartment industry, and it's I read all the industry news. I'm a part of YPO, and I'm part of the multifamily division there. We always meet once a year. We have a big symposium. So I'd say friendly competition, and we share best practices with other multifamily owners.
Will you be at the YPO Global Real Estate deal in LA this year?
I will. It's in my backyard. Are you part of YPO too?
I am. I'll be there. I literally signed up last week. I'm excited.
Excellent. I'll see you in person. Did you go last year in Montreal by any chance?
I didn't go last year. This will be my first year. We have a Texas council that we do quarterly with all the CEOs around Texas, which has been amazing. But this will be my first global.
Got it. That's where I met Adam Blake from YPO. So just joined a year ago myself, and it's been a great experience. So I've done the multifamily symposium and the global real estate, which was really cool to meet other like-minded, relatively younger. I think to be part of YPO, you got to be under 45 to join, and then you age out at 50. It's a great organization. Anyone listening, if you qualify, there's certain qualifications in terms of number of employees or revenue or assets size. You can go on their website. If you qualify, I'd say definitely look into YPO. It's a great organization. I've made a lot of new friends that way and learned a lot in the process.
It's incredible. It's been one of the most life-changing things that I've been a part of, and I don't say that lightly. You mentioned having 600 investors. Do y'all raise money from, I'm assuming, a lot of individuals, but do you also have kind of go-to groups that write much larger checks than maybe an individual would? Or how have you gotten to 600 investors?
Yeah, so we got to 600 investors literally one at a time. We started with one investor the first investor was a gentleman who worked for my dad 10 years ago, maybe. And this was 10 years ago. So a long time ago, he was an attorney at my dad's law firm and moved to Israel and was catching up with my dad and telling him he was interested in real estate and investing in America. And literally, my dad was telling him about what we were doing. And that was our first investor. And then the second investor was a family friend who invested with us that has known, my family a long time. And then I started having my own personal friends come in, and then the family friends started telling other friends, and then my dad started having some clients come in, and we've built this one investor at a time, one property at a time. And we have a minimum investment of $100,000 per deal, which is stated in the offering memorandum. However, if someone wants to start with $50,000 just to get more comfortable with us, that's fine as well. Like the current deal we're buying right now, we're closing on in a month from now, is a $62 million purchase. We're raising around $25.5 million. We have around 150 investors in that deal. So, wow. If you do the math, we have a ton of $100,000 investors, which is the most common check size, but we have some larger ones that skew it like up to $1 million, and then some 50s, even 25 if someone's younger, up and coming, really hungry that I like. The earlier you can start investing, the better, as long as you don't need these monies. These are illiquid kind of investments, which I actually like. I like that you can't click a button and sell it in a panic.
Right.
Where I've done that in the stock market, and I wish I didn't. Like, I had Netflix that, all my bar mitzvah money was in Netflix, and that would have gone up 100-fold if I didn't sell it when it only went up 2 times because it dropped and I got scared or something. So I like the illiquid nature of it, actually, and it's actually really good for a lot of our investors. We have a lot of investors now that are in professional athletes, for example. One of my newest team members was a former professional athlete for the New York Mets, and he has a lot of teammates and friends that are investing with us, and it's good because they have short careers, and this is something that will grow over time. And once they retire, the cash flow from these assets hopefully will be enough to be able to live off of and not have to dip into the principal. So we have people from all walks of life, young, old, business people, professionals, retired people inherited money, whatever. As long as someone's accredited, we can work with them. And that's the business model we have. It's a syndication business model, but there's so many ways to do real estate. You could do it with your own personal money, and it'll grow slower, but you start smaller and keep refinancing or selling and doing it, building by building. And I know a lot of successful people have done that. I know successful people that have done institutional JVs. They partner with larger funds, and it's a lot more costly, that capital, but that's the way they built their business, and they've been successful doing that. You have people that have done a fund structure where they go out and raise funds, starting small funds and then over time getting to larger and larger funds as they develop. And there's no right or wrong. It's just, I think, what's the DNA of your company? What's your long-term goals? And I think syndication aligns best with us because we like having personal relationships with our investors. I like making our, family and friends of friends money. And I like holding these assets long-term, whereas a lot of funds and JVs, they have a 3 to 5 year kind of horizon. We're long-term, visioned owners. That's the way to make money, in my opinion, in real estate. Just buy and hold and take good care of the assets and let time do its work. One of my mentors said, time and inflation are real estate's best friends. And I really, truly believe that. Anything we've sold, I sort of regret because it's resold at a higher price, but we needed to sell to create a track record. But nowadays we're selling occasionally only, and we're pretty much doing supplemental financing or refinancing to get some equity back, but long-term goal is to build just as large of a portfolio as possible, and do good for our stakeholders, our investors, and our renters. Providing good, safe, affordable housing for them, making good, consistent cash flow and upside for our investors. And if we do well for all that, we're going to do well too.
Yep. So these deals happen pretty quick. They happen in 60 days. You've recently raised this $25 million for this latest purchase. What's your process for raising? Do you use software to help get the deal out? And we use a platform called Juniper Square for all of our fundraising and investor management. But how do you do it?
Yeah, so I actually use their competitor, IMS. We were pitched Juniper and IMS. We chose IMS for different reasons. I wasn't too involved in the decision-picking process. I'm sure both of them are great. And once you have a lot of investors, some kind of software tool is good for that. So we always disseminate the offering memorandums and stuff on that. So literally the process goes like this. We look at a ton of deals. If we like a deal, we'll bid on it. If we bid on it, we get into the best and final. Usually we really try to win it. If we do win the deal, then everything starts. We have, we're negotiating a purchase sale agreement simultaneously. We're doing all of, sometimes we start with an access agreement even before a purchase and sale agreement is signed. But we start doing all our physical due diligence, walking all the units, inspecting all the major systems, doing a lease file audit, just making sure what was presented is what was, what's advertised is what is there. Simultaneously, we're lining up all the financing. We put together the offering memorandum. We send it out to our list of our 600 current investors. I got another, give or take, 1,500 that are like potential investors, people that have, told me they're interested and just haven't pulled the trigger yet. Everyone I meet, pretty much, I talk to them about what I do, and I'm passionate about what I do, and I think more people that have a little money in savings should park it in real estate. I think it's good for most people's portfolio, and so then we put out a due date where all the funds are due. I call it like herding cats. So sometimes we have people that come in early, some people come in a little later. So we always have our own lines of credit and cash to close a deal in case it takes a little extra time. And
Right.
some cases we've oversubscribed deals and we've had to give back money. Sometimes we just shut the deal off once we hit the dollar amount and just tell people sorry, it's too late. It's sort of on a case by case basis, but It does happen quick, like you said. Usually it's around 60 days from start to finish, because we usually try to get 30 days DD, due diligence, and 30 days thereafter to close. Sometimes we got to do it a little quicker. Yeah, definitely, it's nerve-wracking raising a lot of money really quickly, but we have the track record and we have a huge investor base. We don't have to rely. I'd be more scared if you have to rely on one partner that could say yes or no, and if they say no, you have to back out. So any deal that we go under contract on, we're too small not to close on it. So we closed every deal that we've gone under contract on, except one where they had a material retaining wall that had a huge issue with it. It was going to be $1 million to fix. The deal was a relatively smaller deal, maybe 10 to 15 million. So we tried to either get it fixed or get a credit. The seller didn't want to budge, so we had to walk. But other than that, we've closed all the other deals we've gone into.
So you started out, you were doing it all. You were finding the deal, buying the deal, helping rehab the deal, manage the deal, and your company's grown. You're now across the country. I have to imagine your job has changed quite a bit. What does your job entail today?
Yeah, my role totally changed. I mean, Damien and I used to do everything. We sort of, he focused on the rehabs and dealing with the contractors. I focused on the new acquisitions and raising the money. And we sort of shared the asset management part of the job. And then we hired another younger gentleman who helped us we couldn't afford to pay anything. So we gave him, I don't even know, $500 a month, but made him a third partner at the time. And then we always sort of added people as we needed. And we're up to like 25 people. And we have the different departments. We have asset management. That's one department. So we have a head of asset management with asset managers under them. We have acquisitions department with a head of acquisitions people under them. We have a COO. We have an accounting department with 5 people in it. We have our in-house legal, probably forgetting some. We got our own construction management individual. We have two people that oversee our ground up development, another gentleman that oversees the manufactured housing communities. We didn't really talk about it, but we have one gentleman that oversees the venture fund, the early stage tech startups we invest in. So I'm a big believer in bringing people in. I always, every day, I have people that want to work for us and just reach out to me, which is an amazing position to be in. I think it's because they just word of mouth. People tell people how we're doing very well and doing well for the investors, and it's a great culture and great organization. And I get to cherry pick who I want working for me. So we've hired a lot of people over the years that didn't really fit in a particular box. They just exhibited, criteria that I thought would be a good cultural fit. And we sort of made a position for them. If they started in one position and it wasn't working that well, we veered them into a different direction where they'd be a better fit, and just really play to people's strengths, essentially. So we've had very little turnover in terms of staffing. Everyone that's left has been sort of left. It wasn't a great fit to begin with. So all the core team members are still here, and we incentivize everyone in the office to, stay and build for the long term. We've historically started pay a little bit on the lesser side on the salary, but over time really grown it a lot quicker in where you would make in any other organization, and also given pieces of all the cash flow and the back end to promote to all the staff members, and really trying to align ourselves with them and have them be happy in this work environment and stay long term. And I think they like being here. It's part of our DNA to be entrepreneurial, and every day is something different. And definitely nowadays I'm just marketing, investor relations, like raising money, more big vision, where are we going with this company, new hires. And be honest, and I tell people I haven't gone to a lot of our recent acquisitions because I trust my teams that much on the acquisition front. They've gone to hundreds and hundreds of buildings. They know what we want to buy. They know how to analyze a deal better than I can nowadays. So I tell people, which is true, I don't even know how to use Microsoft Excel. I don't know how to use so like I literally am really focused on those things, those activities: marketing, raising money, direction of company, strategy, and making sure everyone works well together. We just started doing some business coaching for the executives here, and that's been great. So it's really scaling this business and growing the team has been integral over the last few years.
That's fascinating. I literally, and I'm not kidding you, I told I was with our analyst yesterday and a few other folks, and I said, guess who is the worst person on Excel in this entire company? Me. I am.
Yeah.
My original Excel model was a little one pager, and I know how to read them. I know what they mean, but I cannot build them. I am awful on Excel.
Yeah, I mean, I literally could just put numbers in fields. I don't know anything else. But even for the beginning, I didn't joke. I mean, I could have learned it myself and done it, which some people do. But that actual third person we brought on was our analyst, and we sort of hired to where our weaknesses were and really focused on what we were good at. And I think that's important for any people in their careers.
Where and this is a question I get asked a lot, and I'm sure you do as well. And I never have a great answer because to me it just feels like it will never end. There's always something else. But where is your company going to be in 10 years, or what's the end point, or does it survive you, or what does the end look like?
Yeah, so the end is my life is over, and hopefully, God willing, one of my kids will be in the business. If not, one of my kids will have good leadership in place that takes it to the next level. So, I think it's not, I'm never going to liquidate these buildings. Occasionally we'll sell a building here and there to create some liquidity and put some money into our pocket and our investors' pockets. But yeah, I'd say we currently own around 5,000 apartment units. And I'd say I'd love to own, a nice round number of 10,000. But in all reality, the sky's the limit as long as we're doing a good job. And, I think, the sky's the limit. But definitely, it's just a nice round number. And eventually, breaking into the top 50, owners in the U.S., you got to have around 20,000 units. But there's only maybe one or two other syndication companies that are on that list. They're mainly like publicly traded kind of companies or large funds that deal with institutional kind of investors. And I'd say just staying with our DNA and how we're building this business. And I'd say, trying to own, we always try to invest as much money as we can in our own deals. And I'd like to just becoming a bigger and bigger portion of the capital raises over time as we grow this thing. The investors always, that's the first question: how much money are you putting into the deals? And, the truth is I put as much as I can into the deals, but, and which is scaled. I started very small and now it's getting bigger and bigger. But I'd say
real estate's expensive.
Yeah, real estate's expensive. It costs a lot to run the business here. But the beauty is I'm not under the gun to buy buildings, whereas the people that raise the fund, they have a finite time frame where they have to deploy the capital, so they'll start overpaying for things. And it's very important to be patient. I think, especially as the prices have gone up over the last call it 7-8 years, we've been more picky and more patient. And one of my mentors always taught us it's better to regret not buying a property than to regret buying a property and having issues down the road. So definitely, try to heed that warning.
Do you think growth will come through a property by property acquisition, or do you think you'll eventually start buying out maybe companies or entire portfolios growing that way?
Yeah, portfolios. We bought a bunch of 2 property portfolios. Yeah, I guess once we're large enough, and as long as some points of the cycle, like right now, I think people are paying up for portfolios. A lot of these large companies need to deploy capital, so the larger the portfolio, they'll pay a premium. Whereas sometimes in the market, if someone needs to dispose of a lot of assets and it's a just depressed situation, you could buy it and at a discount, than buying them one by one. So, we're sort of constrained. We can only maybe raise up to, I don't know, call it 35 million on any one particular deal. We only try to do one deal at a time. So eventually it would be great to just be able to do larger portfolio buys or multiple deals at the same time. But it's literally very hard to find deals now anyway. So it's not like if we found more deals, I think the money still would come. It's just very hard to find good opportunities right now at this point of the cycle, but they are out there still.
Yep. No, that it has gotten a lot tougher. I got a couple more questions for you. This has been fascinating. First is, what does Gelt stand for? GELT Inc. is Keith's company. And what does that stand for?
Yeah. So literally the word Gelt means money in Yiddish. And, I grew up, my grandparents are Holocaust survivors, and I wanted a cool, short Yiddish word that was part of our DNA. And, not just money, but it means like during Hanukkah time, we give these chocolate candies, Hanukkah Gelt. And it's, I don't know, it's a cute kind of thing. And it involves like giving back. And, we're very charitable in all the different, communities we invest in. But not just that, we literally just started a 501c3 called Resident Relief Foundation. It's a public nonprofit that we're covering 100% of the overhead for. So all the monies that come in go out to renters that are in need of funds because of a financial crisis. So some of the people have had job losses is the most common. Other people, had medical bill, car accident, different things that they would have been on the street or evicted. And we've literally had a lot of industry support and have helped 50 individuals and families last year, hopefully double that to 100 this year. So really give back to the apartment community, because without renters, we wouldn't have a business. So, apartment owners are starting to be seen as sort of greedy, money hungry kind of, companies and stuff. And, we had Prop 10 that almost passed here, that was going to do more. And some states, they have blanketed rent controls now, so I'd say there's a lot of pushback, and we want to try to show that, have a good PR campaign for our industry, but also to really help, people that need the help, responsible renters that have not never, but I think we have a criteria, 9 months of paying rent on time, no late fees and stuff. And, we help. It's a win-win-win. The apartment owner gets to keep a good tenant in there. They don't have to have any eviction costs, downtime costs, rehab costs for the unit. And it's a win for society, because that person, a lot of these people would have maybe been on the street. We have a lot of veterans we've helped, people. That's
incredible.
Yeah. And our first few people we helped were in your state of Texas. When you had your Hurricane Harvey go through, a few residents contacted us via their management companies. We always give the money to the management company, so the resident can't use it to buy, big screen TV or whatever. So it has to be used for the payment of rent. And a few single fathers that worked multiple jobs, they had their places of employment, were damaged and were closed for a few months, but they're home. They still had to pay their rent for their apartment community, right? So they didn't even understand about eviction and what happens to your record and how hard it is to find another home once you have that on your record. So we literally helped keep those individuals, and they had kids in their homes. And our average grant's only been 1.6 months worth, I think, of rent. Originally, I thought we were going to have to give up to 6 months of rent for people, but people are pretty resilient. They just need that hand up instead of a handout, just to, give them a little breathing room. We were talking offline a little bit about a company we support called Lambda School, which yesterday they just announced that they are going to be paying a living stipend of $2,000 per student for their 9-month program. It's a computer science program for programming and iOS development and coding and stuff beyond my pay grade. I don't think I could do, but they literally, they have over 1,000 concurrent students right now. They just started a year and a half ago. They're paying the students to go right now, and they make money on an income share agreement. Once you have a job that pays over $50,000 a year, they split in the income for like up to 2 years, and it caps out at a certain dollar amount. And literally, they are now paying, the students. So it's leveling the playing field. You're going to have students from all walks of life. Most of their students are not, college age. They're actually people that are changing careers. They're stuck in dead-end jobs. They're tired of working for minimum wage, and they do this program. They're smart enough to learn how to code and whatnot and change careers, and they start earning, the average salary is close to 6 figures. It's pretty crazy. I mean, they're taking people from $15 an hour to $75,000 to $150,000 annual pay, and it's unbelievable. And that's a company that we invested in early on in the education space, and it's just I don't know. I just love the company. It's doing well financially, but also helping tons of people, and it's just going to continue to grow, globally, I think. So.
I've been fascinated by it. And so, to confirm, if you are looking for a job and computer science is in need of many new people, you can go to Lambda School for free, and they will pay you a stipend. And then once you have graduated and you get a job, then you pay them back. So the traditional university, where a lot of students are going into a lot of debt with no guarantee of a job or a future that could even pay off that student debt, it's the flip with Lambda. They're holding themselves accountable, saying, if we can't make you successful, you don't pay us. And by the way, we'll even pay you to come to our school. That is not only going to be a fascinating thing for consumers. Any university that's not keeping an eye on this model better start looking quick, because I have a feeling it's about to flip how we've thought about going to school forever.
Exactly. I mean, look, I think a 4-year degree, it's going to have its place still, but I don't think it's a fit all. I don't think every single person needs to go to college and a lot of people, they're better off going to a trade school. Essentially, Lambda is like a modern day trade school that's training for new age jobs. And I think I had the luxury. My parents paid for the school. I got some scholarships. So I graduated without the debt. But if I was to, go to USC again and have to pay out of pocket or get student loans, it would have costed $200,000. And, it was a great experience for me, I'd say, because I met a lot of friends and connections when, supported the football team, whatever. But I think it's not for everyone. I think, a lot of people, they're better off going the route of, doing some kind of trade school, learning a trade, getting an internship, starting to work a little earlier. I was working all through college. I was telling you offline, I started Keith's Bargain Center. We sold around 200,000 items on eBay during my years of college. So I was always working at the same time as college, but 4-year college is it's not a fit all for everyone for sure.
No. And I think people would be surprised to hear this. When I look at resumes, I very, very rarely ever even look not only where they went to school, if they went to school. It just, in today's world, you can learn online so much, you can read so much and be even more educated than people went to school. And so it's not a criteria for working at Fort Capital. And I imagine you share a similar philosophy.
I'm 100% the same way. I could care less where they go to school. I would be more, excited if they didn't go to school, but they learned on their own and took the initiative and, excelled through, like Austin, for example, at Lambda School. He dropped out of school. He lived in his car for 4 months. He's a very resourceful guy, was homeless for a period of time. We're looking at another company, same kind of founder, Hungry, where they weren't just given everything. And I think, look, if you have the opportunity to attend some of these elite universities, I think the social capital is the best thing. And signaling, like you said, from some people, employers, but for guys like you and me that are more entrepreneurial and we understand, having an Ivy League on the thing, it just means it could have been a great student, or B, with this whole bribing scandal thing that just happened, you could see maybe Papa had dough and bought their way into the college. So it's pretty crazy, the world we are. Yep. But definitely, I share the same view as you.
It's changing quickly. Well, I'll wrap up with one more question, and I think you've answered it in different ways throughout this great conversation. But for anybody listening that's on the fence about starting a company or wanting to move up in the company that they're at, or anything that they're taking some risk, what would you tell them have been some of the critical keys to your success and things that anybody could do that don't need money to do them?
Yeah, so I'd say start small. If you start small, your mistakes will be small, right? So the first building we bought, literally didn't have any money, didn't want to go to my dad for money. So we got an FHA loan, only 2 or 2.5% down. We borrowed that money. So we borrowed $5,000 from a friend. We got a cash advance of $10,000 on a credit card to do the rehab. And that's how we bought the little first fourplex. And I say, as an entrepreneur, you got to figure out how to be resourceful. Every business, that starts pretty much start small and you learn from your mistakes. My path happened to be, I've never worked for anyone. I started my own company. A lot of people's paths, they started, at smaller or bigger companies, learn as much as they can. That's the best education. Instead of going to college and paying, you could get paid and work for someone else and learn what to do and what not to do. And I'd say align yourself with good mentors early on. There's a ton of people that want to give back if they see someone that's young and hungry and that wants to put in the work. So I'd say have good mentors. Be resourceful, find something that you love and you're passionate about is also great. I fell into real estate. I'm lucky. If I wasn't doing real estate, I'd probably be doing some other kind of business where, I really love doing it. I wasn't in love with, buying and selling general merchandise. And, I just sort of fizzled out of that thing. I sold all my remaining items and I looked for a new career path. So find something you're passionate about, and internships are a great way to do that. When you're younger and stuff, or, just, that's sort of my advice.
Yeah. When you're young, take risk. You don't have family and overhead and much more risk of downside. When you're young, it's all upside.
Yep. 100%.
All right, Keith, it's been great chatting with you. I really look forward to getting to know you better in the years to come, and especially out in LA in a few months at the YPO Global Conference.
Yeah, looking forward to meeting you in person, and definitely thanks for having me on the show. If any of the listeners want to connect with me, just email me, keith@geltinc.com. You could also follow me on Twitter. It's Keith_Wasserman. I'm big on social media, so even Facebook or Instagram, you could find me as well. Instagram's KF Wasserman, I believe. But definitely reach out if you guys have any questions. And thanks for having me on the show, Chris.
Hey everyone, it's Chris here again. Thank you so much for joining me on this journey. If you enjoyed the show, please follow the show on Apple, Spotify, or subscribe on YouTube. Thanks again, and I'll see you on the next episode.
Chris Powers is the founder and chairman of Fort Capital LP. All opinions from Chris and guests of the Fort podcast are solely their own and do not reflect the opinions of Fort Capital LP. This podcast is for informational purposes only and should not be relied upon for real estate or investment decisions. The Fort with Chris Powers is produced by Straight Up Podcasts.